Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone out there for supporting the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, in response to a couple different viewers on my prior few videos discussing options, I want to go through all of the buy and sell orders with regards to options trading. I tried to break it down as simple as I could on my last few videos, as well as my introduction videos. A few viewers did point out, however, I wasn't entirely correct about the buy side of the options trading. So I want to go through and kind of clear up any details that may have been lost in my prior videos. Again, I was trying to break it down from the sell side of the order set and trying to break it down as simple as I could. However, options trading gets quite complex, and technically, I guess I was not verbalizing exactly what's happening when you buy a contract. So let's go through those just to clear up any errors that may have been at least reported on those prior videos. So if we go to trade options, you'll see that the menu for options trading pops up. Definitely does have a nice little tutorial here with regards to the buy side of the options trading, buying a call, buying a put. Unfortunately, it does not go through selling a call or selling a put. You just have these two options here. It's quite expansive, however, with a couple different examples. So definitely, I would encourage you to check that out if you are interested in options trading. But for today's video, let's just go through very quickly all of the 4 different ways in which you can trade options. Again, I'm focusing on the sell side of the order set just because I find that to be the most easily understood way of trading options. And this is what I've been doing on the portfolio to make passive income with stocks I already own in the portfolio. If we take a look up on top, you have sell call. This is what I've been doing for stocks that I hold in the portfolio. So if you sell a call, you're essentially entering into a contract where you have to sell off the stock at a particular price point by a particular day. So by the day, if we take a look up on top, you see December 7th, December 14th, 21st, so on and so forth. Those are the expiration dates. That is how long the contract is valid. So by December 7th, the contract will either be exercised or it will expire worthless. And when you sell off a call, essentially you're hoping it expires worthless, make a little bit of passive income on the portfolio, and then you can start repeating that every week or however often you want to enter into these contracts. You can essentially, take this all the way out to January 15th, 2021. If you would want to do that, you'd simply enter into that contract, and then you wouldn't have to do anything until January 15th, 2021. Either that options contract would exercise on or before that date, or after that date, it simply would expire. If we take a look at that date, you'll see that the options premiums go up quite a bit as well. $2.53 per contract FEC for a $32 call. If we go back all the way to December 7th here, you'll see that $32 call is simply a penny, just because of the risk associated with that time point that far into the future. The more risk, the more reward you get with these types of options contracts. So focusing on the sell call, if you enter into this contract, you're selling off the call. You'd essentially be selling the call off to the person who bought the call here. So if you sold off the call, you are required to sell stocks at a particular price point. So for example, if you take a look in the middle, the share price is currently at $30.73. If you enter into a $31 call, you would hope that if you sold the contract off, the stock would never get up that high, the contract would expire worthless, and you would get 15 cents per contract which you entered into. So you're required to do that. If the stock got to $32, for example, you would be required to sell at $31, losing $1 of upside potential. So essentially you'd be risking losing that upside potential for that options premium. On the other side of things, if you bought the call, this is where I did try to gloss over a few details for the sake of simplicity, but definitely lost a little bit of the detail. When you're buying a call, you're entering into a contract that gives the buyer of the contract, if you buy the call, the right but not the obligation to buy a stock at a particular price within a particular period of time. And you have to pay for that particular call. So for example, if I go back to sell call, you'll see on the right, for example, that $31 call, 15 cents. That 15 cents would be credited to your account. Since each contract is 100 shares, that'd be $15 credited to your account. If you bought the call, however, you'd have to pay $15 So you'd be down in a negative $15 for each contract. Each share 15 cents times 100 shares, $15 down. So you'd be minus 15. But again, you would have the right but not the obligation to call away shares from the other person. So you would force the sell call person to sell the stocks to you. So what I said on the prior video was incorrect. You would essentially buy those shares at that particular price. But then what most people will do is sell the shares off at that point because, for example, going back to the prior example, if the stock went up to $32, if you had to sell off the contract here, again, you get $15 credited to your account, but you'd be losing $1 per share. So you essentially lose $100 on the trade if the stock went all the way up to $32. However, if you bought the call, you would pay $15, so you'd be down negative 15. But if you could buy the stock at 31 and then sell off at the trading price of 32, you'd make $100 minus the $15 you had to pay for the contract. It's essentially make $85 on that trade. So while you do get the right but not the obligation to buy the stock at a particular price, most folks will then sell that off. So you'd essentially be selling off the stock at the market price, buying it for whatever the price was on that call contract. So that was the big difference between those prior videos and this video. Kind of glossed over that detail just because it gets very complex when you go into all of the specifics around buying the call. Selling a call off is fairly easy to understand. You pick a particular price, you're required to sell the stock at that price. You hope that the stock doesn't get up to that price. The expiration simply expires worthless. You keep that options premium, and then you go ahead and repeat that down the road. If you buy the contract, you hope that stock price gets well above that call price or that strike price, so then you can buy the stock at a cheaper price and then sell it at the current market price to make that difference. So a call, if you buy it, is the right but not the obligation to call away a stock from the sell call person, essentially to buy the stock at a particular price. If you do a sell contract, you're required. You can't decide to not do the contract. You're required to do the call if the buyer of that contract wants you to do that. So that is the difference between a sell call and a buy call. A sell call, you get a premium, you get a credit to your account. You hope the stock does not get up above that strike price. If you buy the call, you have to pay for that particular contract, and you're hoping that stock price gets well above that strike price so you can buy it at the cheaper price on the contract and then sell it off on the market. You could, alternatively keep that, but most people simply sell that off so they can enter into other contracts moving forward. So just wanted to kind of correct that on the buy side of things. The sell side, I think, is very easy to understand. The buy side is a little bit more complex. It gets a little bit more interesting when you're talking about put contracts as well. So again, I take a look at it from the sell side. Traditionally, most people take a look, again, from these contracts from the buy side of things. But if you take a look at the sell side of things, you're simply entering into a contract to buy PUT, a stock at a particular price. So for example, with the stock up on screen, AT&T, if I thought that the stock would never get down to $30, I would put a contract in, $30 put, 6 cents. So I would get 6 cents for each contract I entered. Essentially, I'd hope that the stock never got down to that price point. I would not have to buy the stock, and the contract would simply expire worthless, and I would keep that $6. So if you're selling a put, you're required to buy a stock at a particular price. If you're buying the put, you're basically putting it to the other person, and they would have to buy the stock from you. So this is a contract in which you are giving yourself the right but not the obligation to sell a particular stock at a particular price by a particular point in time. So again, this gets a little bit more complex because you're putting it to, for example, the sell person here. The sell put is required to buy the stock at a particular price, and you can put it to them to buy it from you so you can sell a stock at a particular price point. So for example, the sell call here, like I said, you hope that stock never gets down below that price. So if you put in $30 put, you would hope that stock would still stay way above that $30 price point. You'd collect that options premium, the contract would expire worthless. However, if you bought the contract, let's say the $32 put contract, you would have to pay 6 cents per share. So that would be a debit. You're down 6 cents. But let's say the stock crashed all the way down to $20, for example. You can still put it to the other investor. You can put it to the sell put here to buy it at $30. So essentially you could sell it off at $30 and then you could buy it back at $20, essentially protecting the downside of a stock, sort of as an insurance policy. You wouldn't have to buy it back. You would simply sell it off as well and get out of that position. And it's another way to play that particular trade. So I think from the buy side of things, it gets much, much more complex, much more difficult to understand. There's a lot of different ways in which you can use the buy calls as well as buy puts, other than simply making passive income on the portfolio. If you do a sell call, you're making passive income on stocks you already have in the portfolio. If you're doing a sell put, you're making passive income on cash that you're keeping in the portfolio, but not necessarily entering into any positions. That's how I think of it anyway. So you're making passive income on cash with the sell put, making passive income on stocks you have in the portfolio, buy and hold stocks with a sell call. With a buy call, a little bit different. You're hoping the stock goes way up in price so you can essentially buy the stock at a lower price and then sell it off to make that difference. And if you're buying a put, again, you can put it to the other guy to buy stocks from your portfolio, so you have the right but not the obligation to sell stocks at a particular price, again, protecting some downside potential. So I hope that makes sense. Again, I try to go through this as simple as I could. This gets very, very complex, and it gets much more complex than even what I've described in this video. These are simply some of the easiest to understand ways in which you can trade options. Again, I think from the sell side of things, it makes much more sense, at least in my brain, on what we're doing. If you're selling off a call, you're required to sell a stock at a particular price. You get an options premium credited to your account for that. If you sell off a put at a particular price, you're required to buy a stock at a particular price. You get an options premium to do that. On the other side of things, if you buy a call, you're simply calling away the stock from the sell side of things, so you can buy a stock at a particular price. Again, buy it more cheaply than what it's trading for, and then sell that stock on the open market to make that difference. Or if you're buying a put, you're putting it to the other person. You're putting it to the sell put, so you can sell your stocks off at a particular price, protecting some downside potential there as well. You can buy the stock back or simply exit out of the position at that point. So I hope that makes sense. And again, I want to thank those viewers that did catch that on my prior videos. Again, I tried to break it down pretty simple with regards to those prior videos, but I think I did it a little bit too simple and definitely missed a couple key aspects of the buy side of options contracts. So again, if anything in the video does not make sense, please let me know. I'm always willing to update the video based on what you guys think is happening in the video. Sometimes things aren't explained entirely correct. I try to do that to make these videos as simple as possible, understanding that a lot of you guys don't have a lot of background in options trading. But if I make it too simple and miss some key details, please let me know. Always willing to update videos, again, based on what you guys are seeing in the video. So thank you very much for those other viewers for showing that to me, and I hope this makes more sense. If it doesn't make sense, please let me know in the comment section down below, and I'll, again, focus on content that is not making sense or what you guys want expanded on with regards to options trading. It gets very, very complex, much more complex than simply buying and selling stocks as you would traditionally do with the stock market trades. But this is a very powerful way, again, to make passive income on the portfolio from the sell side of things, and then doing some more complex trades from the buy side, buy calls and buy puts, which I will be expanding on in other videos. But for this video, just wanted to go through the very simple 4 different types of trades in which you can do the sell call, the sell put, and then the opposite of those, the buy call and the buy put. And again, if anything does not make sense in this video, please let me know, and I'll do an updated video like I did with this video regarding any specifics on what is asked for in the comment section. So again, thank you for those updates. And again, if you guys have any other great video ideas, any content issues, stocks, trading strategies, particular stocks that you guys want a little bit more info on, please let me know. Definitely put that on my short list for videos to put out here over the next few weeks. So again, I want to thank everybody for supporting the channel. If you guys do like the content on the channel, feel free to like, share, and subscribe. Think about hitting that bell button if you are a subscriber to get notifications on all updated content. And yeah, kind of with that, I'll end the video, and we'll see you guys next time.